We come down a little ways, say waste management, right? Outperforming the market, 3.9% earnings yield. Past 5 year growth has been 104%, so the stock has doubled in the last 5 years. You got a price to earnings ratio, which is 25.6, which is a little high for a utility company like Waste Management, but volatility is below the market average and it's under its 50 and 200-day moving averages. So all those things combined, it tells you it's outperforming the market, it's less volatile than the market, and right now you can be buying it at a discount. And so that is what this table is here for, to identify the exact moment or moments. I think waste management's been under those indicators. It's been close to its 50-day moving average of $102, but it's been a little bit underneath that just due to the economic slowdown. But I mean, if you think about waste management's business, they deal with trash, and the economy might slow down, but there is still plenty of trash to be picked up, thrown out, processed. Some people may have canceled their trash pickup services, but overall, I think Waste Management is in a good position. And overall, they are regarded as a company that can weather recessions fairly easily. So I think right now this is this is one of the companies that this table is meant to identify. And we can keep going down. I'll show you a few more that we've got in here. So we come down to JP Morgan, big bank, high earnings yield return, 9.6%, almost triple of waste management. And that's just because it's in the financial sector. Financial stocks tend to have high earnings yields. But again, you come over here, you got a price earnings ratio of 10.47. That's pretty low. And it is under its 200-day and 50-day moving averages. A little more volatile than the market, but it has slightly outperformed the S&P 500 over the last 5 years as well. And then we'll move further down the list. Now, I mean, just as a side note, this isn't supposed to tell you, this isn't a fortune cookie. This isn't like going to tell you exactly what to buy, when you should buy it. I have 211 stocks on here right now, and I increase that number whenever I see fit, whenever I come across companies that I'm interested in. Okay, here's another one, a name that everyone knows. Texas Instruments, TXN, listed as outperforming the S&P 500 by almost a factor of 3 in the last 5 years, 110% stock price gain. Right now, it's under its 200-day moving average. It is just above its 50-day moving average. It's at $115 a share, just slightly more volatile than the market. It's got a 22 price earnings ratio. So, I mean, you're getting good performance over 5 years. I mean, that's 20-something, 22% a year, and outperforming the market. So right now is not a terrible time to get into Texas Instruments. It was hovering around 120 for, I think, the last quarter of 2019. Basically, I was watching it last year, more intensely, I guess you could say. And then if we come further down, some stocks you might not even think about buying. Louis Vuitton. They make, high-end luxury goods. Their stock price is $346, a little on the expensive side, but right now it's under its 50-day and 200-day moving average. It's got a price to earnings ratio of 24, so not too high. And just as a reference point, the S&P 500 over the last 100 years, the price to earnings ratio is it's right around 15. So anything over 15, you could say is too high, but we are also in an era where investing is massively available to people, But anyways, outperforming the market. We don't have a beta calculated for this one. For some reason, it's not showing. But I can tell you from watching Louis Vuitton, I do not believe that they are a very volatile stock. but they are below their moving averages. They have outperformed the market in the last 5 years, 123%. So that's nearly 25% a year, right? And right now just happens to be a good time because we're in an economic slowdown. People aren't buying luxury goods like they typically do. But rest assured, when the world is back on track, I mean, I don't know if you've noticed, but Louis Vuitton still hasn't gone anywhere. And there are plenty of people who make lots of money buying their products still to this day. Um, okay, so actually, one that you might not suspect right now that would be a good buy, because we're kind of in a down market for the meat industry, Tyson Chicken. Um, right now, they are at $59 a share. They're below their 50-day and their 200-day moving average. But they've outperformed the market by 6% over the last 5 years, 45 percent over the last 5 years. That's about 9% a year. It's not 20-25%, but you're not always going to get those numbers. But what you do get is a very low beta, and it is less volatile than the market by a good bit. So that is also something to take into consideration when you're building your portfolio. Don't put all your eggs in one basket, and don't put all your eggs in a lot of baskets that are all very volatile, because the market swings will highly affect those stocks more than it will affect stocks with a lower volatility. Um, that's just how it is. Usually, companies with low volatility, they have a cash mode. They're in a industry that does not go out of style, so to speak, like food, like waste management, things like that. And we'll keep going down the list. Just see what else we have here. Yeah, as you can see, I've stockpiled a ton of these companies. And at the bottom, actually, today I added Clorox, Adobe, and Fastenal. They were all listed as outperformers, so I went ahead and did some quick research of my own and added them. But as you can see, I'm a little late to the party. They're all above their moving averages, but they're all solid outperformers. And Adobe actually has 374% over the last 5 years. I mean, you're talking that's like 75% a year, you know? So and again, past performance is not an indicator of future performance or future gains, right? So you gotta do your research. You gotta make sure that the company that was outperforming the last 5 years is going to continue to outperform. And those are companies like Apple, Google, Microsoft. And if you notice, Apple outperform, Google outperform, Microsoft outperform, Amazon, Tesla. All these stocks that people are that are high visibility. Even Johnson Johnson outperform, McDonald's outperform, low beta under the 200-day and the 50-day moving average. I have stock in McDonald's right now. I should probably buy more at this time. Again, this is not investing advice. I'm not a financial advisor. Realize that most people, like 8 times out of 10, lose money in the stock market. It's not because anyone is incapable of investing. I think people just they listen to the news too much instead of doing enough research, instead of really knowing what they're putting their money into. I certainly don't make money 100% of the time. It's just not going to happen. You can't predict everything that's going to happen, especially these days. Very event driven news and media. So I hope that helps. I will do more of these if I can. I've got some other things that I'm working on with this spreadsheet. As you can see at the bottom, the two other tabs I have, cyclical and sector. Those are just some different analysis tabs that I might get into later on. But thank you very much for listening.